to the Going Long podcast. Today, our guest is Mark Wiseman. Mark is a co-founder of FCLTGlobal, having founded the Focusing Capital on the Long-Term Initiative more than a decade ago. He's currently a senior advisor and chairman of Lazard Canada, a senior advisor to BCG, and previously chaired the Alberta Investment Management Corporation, or AIMCO. From 2016 to 2019, he was senior managing director at BlackRock, where he led active equities, chaired the alternatives business and the Global Investment Committee, and served on the firm's Global Executive Committee. Before BlackRock, Wiseman was president and CEO of the Canada Pension Plan Investment Board. So, Mark, thank you so much for joining me on this podcast today.
Great to be here, Sarah. Thank you for having me.
So FCLT was really the brainchild of you and Dominic Barton in 2013, 2014. So back in that time, there was a recognition on both of your parts that this quarterly short-termism was really challenging companies, and that a big part of that was a result of the investors and the relationship between investors and companies. And from that, you started this idea of focusing capital on the long term. Can you tell us what sparked you to kick this off? What was it that really got you going on this?
Well, thanks, Sarah. And I have to say, a lot of what started FCLT was kind of the result of the global financial crisis. And Dominic Barton had written a fabulous piece in the Harvard Business Review called Capitalism for the Long Term. And in that article, he really argued that a lot of the sort of things that created the conditions for the global financial crisis really were due to short-term thinking. And at the time, I was helping to lead the Canada Pension Plan Investment Board, Canada's, the asset manager for Canada's national pension fund. And as Dom and I talked about both the global financial crisis and institutions like CPPIB, we came to the realization that there was really fundamental mismatch. And that fundamental mismatch really was that savers, be it pensioners or people putting money away in their 401k or personal savings, savers, by and large, are very long-term in nature. The reason you save is for the proverbial rainy day. It may be for your retirement. It may be to send a child to college. It may be to save up for a house, or maybe just saving up to give money away to future generations of your family or to charity. So savers, the people whose money it ultimately is, are long-term thinkers, right? They don't care about what happens to their money the next quarter. What they really care about is how is their nest egg going to grow over the very long term. However, something happens between the savers, on the one hand, putting money aside for the long term, asset managers or asset owners, through the type of contracts and arrangements that they have and the type of incentives they have. And then when that money gets allocated ultimately to corporations, decisions become very, very short term. And we saw that empirically. We saw empirically how corporate decision makers would, for example, make a decision that would have a negative impact on long-term shareholder value if it meant in the short term they were going to miss earnings, let's say in a quarter by a penny a share or something like that. So that's really that kind of situation coming out of the financial crisis, all the short-termism that had caused the system to build up leverage to drive short-term returns, juxtaposed by the peoples whose money it really was, the savers, really led Dominic and I to, start to say, well, what can we do about this? How can we try to break this cycle where there is a fundamental misalignment of interest between the providers of capital, the intermediaries of that capital, and the corporations that ultimately deploy that cap.
And that fundamental mismatch still exists to this day. But I think there's more awareness of that. At least it seems that way to me. But how do you feel in terms of progress since that time? In some ways, the idea of being long term is much more accepted, I think, today than it was at that time. On the other hand, we know people and markets still behave in short term ways. So how do you evaluate the progress?
Well, I think we have made some good progress, and I think in part FCLT and under your leadership deserves some credit, because what we've tried to do is to bring together the three key constituents: the asset owners, who are also, intermediaries in that system, because it's not their money; it's ultimately citizens' money or pensioners' money. The asset managers, who are contracted to manage capital on behalf of asset owners or directly, and then the corporations. And bringing those three constituents together, um, I do think has had an impact, at least raising awareness of this really this short-term nature of markets. So on the one hand, I do think there's greater awareness of the issue. Um, you know the statistics, Sarah, better than I do, but I think things like you know um, you know quarterly guidance, people have sort of, there's less of it now. Corporations are thinking more long term. Some of the contractual arrangements between asset owners and asset managers have become more long term in the way that they're structured. But having said that, we still live in a highly transactional world, and the world in general has gotten more short term, more instantaneous, more transactional in nature. So while I think we've made some progress, I think we've made progress in a world that by and large has gone in the other direction. I mean, take this podcast, for example. I don't know how long it will end up being, but if it's a half an hour, that's like 100 times longer than the average TikTok video, which is how most people seem to learn things these days.
Yeah, you're right. Short attention spans are very short, very short. The other counterbalancing factor has been the growth in private markets, which are supposed to be longer term, private equity and so on, supposed to be longer term in many ways than public markets. You have to hold it, you can't sell it. But of course, private markets have also changed quite dramatically in the last 10 years. Do you think that the rise of private markets helps in terms of extending timeframes, or do you think the sort of mainstreaming of private markets will lead them to the TikTok effect as well of having to go the other way? How do you think about that?
Look, I'm still a big proponent of private markets, whether we're talking about private equity or infrastructure or real estate or credit, because they are longer term in nature. The way that decisions are made, particularly in private equity or infrastructure-backed companies, it really is. They're not subject to the vagaries of that, daily or quarterly kind of market conditioning. So I do think the growth of private markets is one of the things that has helped corporations to be more long-term. And I can tell you, I sit on boards of several private companies, and I do believe that they think much more in a long-term fashion than their public market counterparts. However, I also think you're right. As these, the one problem with private markets is, of course, illiquidity. And as we find ways to solve for illiquidity, whether it's being able to trade, private credit, whether it's tokenization of assets, whether it's a continuation vehicle, which are these, extension vehicles that many private equity firms are using, those private companies are starting to look in some respects more like public companies. It's not an instantaneous mark to market, but it certainly is bringing that sort of valuation analysis to be a little bit more short term in nature. But by and large, I mean, I do believe that the rise of private equity, the rise of private infrastructure, in particular, have led to better long-term value creating decisions being made. And I think where management teams aren't subject to the vagaries of the quarterly earnings, I do think it allows those management teams, and importantly, the boards of those companies, to insist in longer term analysis and longer term shareholder value creation.
So you talked a bit about asset owners. Obviously, you ran CPPIB, the Canada Pension Plan, which is a very large pension plan. One of the interesting things that many of our listeners know is that there are a relatively small number of very large sovereign wealth funds and pension plans around the world that have, like CPP, built very professional staffs and are really investment management firms with sort of with one client is one way to think about them. And you've talked about a quarter meaning 25 years for those sort of large funds that have that kind of time frame. Do you think that the increasing power of those large funds that are long term is having an effect on the markets broadly? Is that changing the way markets work as those funds have gotten larger, or do they act like everybody else when they just get into the markets themselves?
I think it's a little bit of both. So the reason that those funds are long term is because either in the case of a sovereign wealth fund, they don't have specified liabilities, or in the case of a pension fund, those liabilities are decades away. And in the case of something like the Canada Pension Plan, actually intergenerational in nature, so that the money is put aside for in many respects for future generations of workers. And so that allows them to be quite long term, including long term in the way that they determine their asset mix. And so probably the biggest impact is not necessarily how they behave as a holder, let's say, of public equities, but it has allowed them to allocate much more of their capital to private markets, which we just discussed, and therefore allows them to be quite long term. I also think from the perspective of public markets, that those types of institutions, not exclusively, but tend to have less of a trading mentality and more of a long-term value creation mentality than, let's say, a hedge fund or another type of investor. So I do think that they've had quite a positive impact in pushing investors and therefore pushing stewards of capital, including boards of directors of companies, to be more long-term nature in their thinking. However, and it's a really, really important however, there's two things that kind of mediate the other way. The first is the contractual arrangements that those asset owners have with the asset managers that they employ. And in many respects, those contractual arrangements are still quite short-term in nature. So if you're CPPIB and you hire an asset manager to help run your money, the way that asset manager is rewarded contractually, and this is something that Dominic and I talked about very early on as well, and in fact wrote another piece in the HBR about. But to the extent that those contractual arrangements reward the asset manager in terms of short-term performance, or there's a belief that if short-term performance is poor, that money will be pulled, the asset manager is going to very quickly look like everybody else, especially in public markets. So that's problem number one: the contractual arrangement between the asset asset owner and the asset manager. They've gotten a little bit better, but I would say by and large, they still feel fairly short term. And asset owners are, as you can imagine, for example, reluctant to lock up that money for a long period of time with an asset manager. And so there's always the threat of redemption in those liquid markets. The second problem is the employees of the asset owners themselves. Because at the end of the day, whilst the constituencies that they represent, pensioners for the most part, or citizens, or future generations of citizens in the case of a sovereign wealth fund, while those constituents may be very long term, if I'm working for CPPIB or one of the large sovereign wealth funds, I'm not getting paid 25 years from it. I need to get paid on a much shorter time frame because I need to eat, I need to send my kids to school, I need to pay my mortgage, and therefore the incentive schemes of how individuals within asset owners are paid is really, really important. And I think by and large, they are still too short term in the way that they are set up. But that's a very, very hard problem because, Sarah, hey, come work for CPPIB or come work for XYZ Sovereign Wealth Fund. And we're going to determine your bonus on the next 25 years of your investment performance. It's probably not a role you're going to be willing to sign up for.
Yeah, the classic sort of mismatch, classic principal agent problem, or classic mismatch between time horizons and incentives of a human and something that extends, a human who's got a working life and something that extends probably beyond that time. So, yeah.
Right. So it's a balance that has to be created. Now, the good thing is, unlike the corporation, the asset owner or the asset manager, unlike the manager of a corporation, they can be much more diversified, at least in terms of the decision making, the number of assets over which they have decision making control, and therefore can sort of price risk for the long term, et cetera, which is harder for the manager of a public corporation, for instance.
You've also argued about the scale of pension funds. So I think there are many small, very small pension funds in the world, but there have increasingly been consolidation in pension funds, whether that's in Canada or Australia or a lot of other countries, that allows those funds to hire people at a more competitive rate, invest in technology, all of those sorts of things. Do you think is it possible to run a small pension fund really well, or is scale the name of the game now?
I think scale matters in almost everything we do in any industry today. And certainly in asset management, be it, asset management, in terms of a commercial asset manager, like, a BlackRock or your former home at Wellington, or working for a pension fund or sovereign. Scale really, really matters. And I think it particularly matters if you want to be long-term, because you need sufficient scale to be able to access things like private markets, to be able to make long-term decisions. So if you have sufficient liquidity, if you're big enough, you can have sufficient liquidity in part of your portfolio, but have illiquidity in other parts of your portfolio. If you're very small, it becomes more difficult. So I think the large funds, by and large, the large pensions and the large sovereigns have more degrees of freedom to be long-term, have more degrees of freedom to make asset allocation decisions that are long-term. And as you said, have more degrees of freedom to kind of have a degree of sophistication amongst their staff and their investment processes that allow them to be long-term in nature. Now, at some point, there are undoubtedly diseconomies of scale. So there's probably a sweet spot in terms of what the right size is, because as you get larger and larger, what happens is any individual investment decision you make becomes sort of immaterial to performance, because you're just so big. And so there's probably a sweet spot between too small and too big. Um, I would say what's considered big is continuing to evolve, um, today, and that's true in any industry. And the economies to recognize economies of scale. I think you can get quite large before you sort of start having the diseconomies problem. But at some point you will.
So you've spent a lot of time at different asset owners and different roles, but one of the things you did a little while ago was taking on the challenge of chairing AIMCO during a turbulent time, an asset owner that had had some ups and downs. And so, can you talk about some lessons you've learned about resilience and governance and those things from an asset owner that hasn't had smooth sailing?
Yeah, well, look, part of it, I think it's a great question, Sarah, because I think it ties very much to the importance of long-termism. And a lot of things that get investors into trouble, it's not to say you can't find other ways to get yourself into trouble as an investor, but a lot of times what gets investors into trouble is actually this short-term nature, right? It's the old adage of picking up nickels in front of steamrollers. And um, you know, being long term really means being an investor as opposed to a trader. And so if you look at what happened, sort of at the front end of the global financial crisis with asset-backed commercial paper, or you look at other, derivatives, where had substantial derivatives losses, it comes from that mentality of a trade, as opposed to saying, look, we are actually here to accrete value in the very long term. And some of that's incentives, some of that's just culture, but there's something else that's also very important. The education of stakeholders around the long term is critical, because one thing that is also true is that a long term investor can underperform its benchmark, can underperform the market for quite a period of time. And so if you're going to think about a quarter, as I like to say, as being 25 years, not 90 days, then you have to ensure that everyone understands and that your stakeholders understand that during that, let's call it 25-year time horizon, that there will be substantial periods where you will underperform your benchmark and you will underperform the market. And so if you don't do that, you end up kind of on the treadmill of either um, taking undue risk to make those short-term gains and sort of developing the trader mentality, or almost as bad from an outcome perspective, simply mimicking the market, basically becoming an index and giving away any possibility that your comparative advantages would have provided to generate alpha. And so the big learning, I think, two things. The first is, of course, ensuring that you have a culture that um, ensuring that you have a culture as an organization. I think this is common, unfortunately, but ensuring that you have a culture that does not reward and indeed reminds itself that you're there for the long run, and incentives, et cetera, to reinforce that. And then second, that there's a really, really strong communication to all stakeholders. In the case of the pension plan, it's the government, it's the unions, it's the individual contributors and beneficiary of the plan, it's the media, um, its opposition political parties. As an operator of a public asset manager, you have to spend an inordinate amount of time, especially if you want to be long term, educating those stakeholders to the fact that you may, in fact, will, by any statistical measure, underperform the broader market for significant periods of time. And so that's the nature of being long term, right? That you kind of say, we're not gonna count the score until the ninth inning is the bottom of the ninth is fully played out. And the score is in the second inning. If you're down 3 runs in the second inning, it may be less likely you're going to win after 9, but it doesn't mean that the game is over. And so that educational aspect of it, especially in a world where we're short term, we like to measure results, we like to be transparent, is really, really important. And it's a skill I think that many of us in the investment industry are still not, have still not really perfected.
Yeah, that's really helpful. And I think I always try to say, yes, if you're behind, in the third inning, you're behind. You're not losing. You're behind. So I think that's kind of that mindset.
Well,
Right?
you're losing, but you may not have lost, and I think that's what's really important.
Yeah, yeah. So one of the other issues that has been sort of around the being long term is the issue of sustainability, ESG. Some people call it different things, but the idea of thinking about non-financial or pre-financial factors, thinking about things that are not, on a typical income statement or balance sheet, and how they affect the value of an investment over time. And you've made the distinction many people have of the value focus versus values focus. So can you talk a little bit about, obviously this has become more political in some places, but the value-based approach to thinking about these issues if you have a significant enough time frame?
Well, look, I think in the long run, and this is one of the great things about being a long-term thinker and a long-term investor, because in the long run, most of the time, values and value converge. And so, you know, I don't really think it matters much what your political perspective is, what you think the role of government ought to be or ought not to be in terms of, let's say, protecting the environment or addressing climate change. Because in the long term, it goes to value, regardless of what your values. And the reason that it goes to value is because the world is changing. We know that. And it will have an impact on the long-term cash flow potential of an asset. And so, I kind of use a stupid example to describe this, but let's say you own a warehouse, you're a real estate investor, and you own a warehouse down by the water, down by the waterfront. If you're a short-term holder of that asset, climate change is probably irrelevant. However, if you plan to hold that asset for 20 or 25 years, you should care about climate change and rising seawaters, because your asset will literally be underwater if you don't pay attention to it. And what happens over time, of course, is that asset, if it was held in the short term, trades hands from individual owner to individual owner. The valuation will decline as you get closer to the point of the asset being impaired. But in each case, it's quite small. Right? The value of the asset will decline because you're getting closer and closer to where the asset will no longer have a useful life. But if you're a long-term holder, you're incented to fix the issue now. you're more incented to fix the issue now. And that may be, not solving climate change. That may be adaptation. Maybe you're going to, build flood controls around your warehouse, or, invest in sandbag technology or whatever it may be. Or maybe you're just not going to buy it at all because you think that the long-term value will be impaired, and you're going to evaluate the cost and return of that asset with a hold period that makes it come into play. So the bottom line for me is that anything we do, and people, we talk about the integration of ESG into the investment process. Let's just talk about the environmental part of that for the time being. The integration of those factors into the investment process is no different than integrating any other risk factor into the investment process. And the way that you evaluate those risk factors, evolves over time as you get more information, as you learn more about what the world is going to look like in the future. So now, because of, for example, the advent of artificial intelligence, there's certain assets you say, well, wait a second, I never thought that this asset was at risk. But maybe now it's going to be, massively disintermediated by an AI agent. And so now I'm going to integrate, AI disruption into my investment process. Of course I am, because now I've learned about a new technology, and it's going to have an impact on the value of my investment. The same way that, the changing environment is likely to have an impact on the value of my investment. So this is what I mean by the power of long-termism, because to me, the power of long-termism is it ought to take the politics out of things, like sustainability, and really have it talk about the impact on the value and the future cash flows of an asset. And at the end of the day, frankly, if I'm a pensioner, it doesn't matter what my political stripe is. I want to make sure, or I'm a saver of any type, not just a pensioner. I want to make sure that the assets that I've invested in, either directly or indirectly, are going to be there to fulfill my objectives in the long run that we talked about at the beginning of the podcast.
Yep. That's really helpful. Really helpful. All right. Last question for you. So as we sit here today, there are all sorts of changes, whether it's AI, there's obviously a lot of geopolitical tension in the world. There's climate change. There's all sorts of other things. If you're a forward-looking investor, a long-term investor today, what worries you most about what are perhaps underappreciated risks over, say, a 10 or 15, 20-year time frame? And what gets you excited? What do you see that you think is something you might like to hold on to for 10, 20 years?
Well, that's a big question for the last question, Sarah. Let me just say a couple of things. I think on the risk side, I think a decade ago, we weren't spending as much time as investors thinking about geopolitical risk. I think, unfortunately, we're in a world today that geopolitical risk has come to the fore. And I think that also is going to increasingly affect the value of assets, and the risk of investments. And we've seen we saw, how, in the wake of Russia's invasion of Ukraine, we saw how the world responded to Russia, put controls on capital, put controls on commodities, et cetera, sanctions. So I think today, both directly and indirectly, investors really need to understand geopolitical risk in a way that, at least in my lifetime, has not been as important. And so understanding what governments are doing, understanding um, the relationship between governments, and then understanding um, kind of the, secondary and tertiary effects of that, including things like capital controls and dollar convertibility and so on and so forth. Foreign governments, the assumption they'll always buy bonds, U.S. Treasuries, even that assumption has been challenged in recent months. And so I think geopolitics, um, it's almost um, it's almost as if, any good investor now has to have, a political scientist or something, in his or her corner when making an investment decision. I think that's really, really different from anything I've experienced in my career. And I think as you allocate capital, you also have to think differently about where zones of safety are, because things that you once thought were safe may not be as safe as you thought. You take U.S. Treasuries as an example. I'm not sure what the alternative is, but I certainly would like to find some alternatives. If there were some, it'd be more diversified on what's, for example, what we used to consider to be a risk-free asset. In terms of the opportunity, look, I mean, there's all kinds of things that are to be excited about today. Obviously, we have incredible advances in technology, including AI. And I think what that's going to do to certain industries, quite positively, um, take healthcare, for example, or drug discovery, or the prediction of climate events, through the use of generative AI to allow you to better underwrite risk. I think all of those things, are incredibly, incredibly exciting. And there are going to be, we've already seen many of them. What do we call them? The fabulous five, or the fabulous five, and the significant seven, whatever they're called. There's going to be companies we haven't even imagined or thought of or heard of today, that are going to be multi-hundred-billion-dollar enterprises. And I think that's really, really exciting. And there's going to be others that will benefit greatly. Again, I talked briefly, a second ago about, drug discovery and healthcare and diagnosis. There's going to be lots and lots of amazing opportunities and great things for the world that will come out of AI. On the other hand, there's things that are decidedly not AI, if you're long term, that should also create value over an extended hold period. The world isn't making any more copper. God isn't making any more copper. God isn't making any more zinc, or aluminum, or nickel. And so, I think that, again, if you have a long-term view of where the world is going, some things will change immensely. But there may be as much value to be had in some things that are inviolable and that don't change. And so, I think as an investor, the great thing about unpredictable times, which I believe we're in, is that if you can cut through that unpredictability and look long term and understand what things in the world are likely to change and what things in the world are unlikely to change, you can generate outsized returns. So it's not the time for the faint of heart, but if you're willing to, I think, do your research, think hard, understand how the world is evolving, there's going to be some tremendous returns to be had.
Well, we will end it on that note. So, Mark, thank you so much for joining me today, and more importantly, for starting the Focusing Capital in the Long-Term initiative, being such a supporter of FCLT Global over the last almost 10 years, and really being that long-term thinker that is, we all know is hard, but it is so critical for the benefit of those savers and communities over time and the next generation. So thank you.
Well, thank you. And thanks for being such a great steward of the organization and incredible CEO. And the one thing I can say, Sarah, is, you only have another 15 years to go until you get your first bonus.
There we go. There we go. All right. Thank you so much. Okay.
That concludes another episode of Going Long with FCLT Global. We hope you enjoyed our conversation today and encourage you to continue exploring our resources and research at www.fcltglobal.org. If you enjoyed today's episode, don't forget to subscribe, leave a review, and share with others who may find value in Going Long with FCLT Global.